Well, I think, first of all, India had a fairly uneven recovery, even heading into the Russia-Ukraine conflict. It's been uneven in the sense of the scarring effects being quite significant for the lower income households, for parts of services, SMEs in the manufacturing sector. So I think this commodity price increase for a net commodity importer like India is a seriously negative terms of trade shock. And there are two particular things that worry us. First is the inflationary impact this will have on consumers at a time when consumers haven't fully recovered. There isn't enough household savings buffer. So the risk that consumers will have to cut back on purchases of some of the discretionary side of consumption because, food and energy is really hard to cut back upon. The risk around consumption recovery comes into question. Second, even if the government partly tries to shield the consumer and cuts excise duty, the impact on government fiscal finances because of lower tax collections on excise and higher fertilizer subsidy basically implies that next year's fiscal deficit target will be hard to achieve. So the risk that government has to either take a fiscal deviation, so slip on the deficit, or cut back on capital expenditure is high. So I think there's clearly a growth angle here. And the additional thing I'll just add here is that unlike other Asian economies, inflation in India has been high. And we do think there's now a pretty high chance that inflation will exceed the Reserve Bank's upper end of the inflation target, which is 6%. So it makes for a very, very complicated growth inflation trade-off for India.
So the implication being here, you're suggesting that the RBI has been caught off guard by all of this. Do you think they're going to respond?
Well, the initial response will be to look through the commodity price increase because it's a supply side shock. And because the recovery has been uneven, the RBI is still biased to actually support growth. But we do actually think that risks of RBI falling behind the curve are rising, because despite there being a negative output gap, there are signs that inflation expectations are actually picking up in India. So while we haven't seen enough broad-based second-order effects, the increase in inflation is not just supply-side driven, it is getting actually broad-based. Expectations, in our view, will move up. So when you have the effective policy rates at 4% or below, versus CPI inflation of 6.5%, I think the risk of the central bank having to pivot is fairly high. In our view, like I said, the initial response will be to look through, but as inflation continues to surprise on the upside, RBI, in our view, will pivot. So we are expecting 100 basis point and rate hikes this year starting June.